Welcome to the Deep Dive. We're taking on a big topic today, peering into what 2025 might look like for the global economy. We've got quite a stack of sources here, everything from official forecasts by the IMF and World Bank to detailed country analysis from Keep and financial market data.
That's right. And our mission, really, for this deep dive is to cut through all that information and pull out the most important insights for you.
Like a guided tour.
Exactly. Think of it as getting the essential economic intelligence you need without wading through every single report yourself. We'll guide you through the key trends, the risks, and specific details that really matter.
Okay, let's unpack this then. We're jumping straight into the 2025 global economic outlook based on these, diverse sources. Let's start with the big picture, the overall global growth forecast for 2025. What's the general consensus looking like according to these reports?
Well, the headline numbers from both the World Bank and the IMF point to global growth stabilizing. They expect it to be around, say, 2.7% to 2.8% in 2025.
Okay, stabilizing. That sounds, okay. But I noticed one of the key takeaways, I think it was from the IMF report, specifically highlighted downward revisions. Is that right?
That's a really crucial point, yes. And it definitely signals potential challenges ahead. The IMF's April 2025 forecast, they actually revised down their global growth prediction for 2025, down to 2.8%.
Okay.
And that's a pretty significant drop, half a percentage point just from their January forecast. So while growth might stabilize, at a lower level, the trend seems to be one of softening expectations.
Right. And speaking of challenges, one really big one that just jumped out from across these sources is trade. Lots of talk about protectionist measures, especially involving the U.S. and China.
Absolutely. The sources outline a range of scenarios here. It goes from, phased increases in U.S. tariffs on China.
Okay.
The current average rate is noted as 19.3% apparently, all the way to the potential for a more widespread trade conflict.
Wow.
And on top of tariffs, you've got expanded tech export controls, potential trade friction, even with traditional allies. It's quite a complex picture.
So what's the actual risk here? If these tariffs keep going up, or if import regulations broaden out, what are we looking at?
Well, the big risk highlighted is a sharp slowdown in world trade volume and potentially significant disruption to global supply chains.
Right.
The World Bank even ran some simulations to try and quantify the impact. They looked at a potential U.S. 10% universal tariff, so tariffs on imports from all countries under a specific political scenario mentioned in the sources.
Universal tariff. Okay.
Yeah.
And what did that simulation suggest could happen to global growth?
Well, their modeling showed global growth could be 0.2 percentage points lower if other countries didn't retaliate with their own tariffs.
Okay, so a noticeable hit.
Yeah. But if those countries did respond with proportional tariffs, the hit to global growth could be even larger, maybe up to 0.3 percentage points lower. And one source also cited a study estimating that U.S. GDP specifically could fall by up to 0.9% in that kind of scenario. It really underscores just how impactful these trade barriers can be.
Definitely. Okay, beyond trade tensions, are there other major global risks these sources are flagging for 2025?
Yes, geopolitical risk remains a significant concern. The sources specifically outline scenarios involving potential escalation in the Middle East, particularly between Israel and Iran.
Right, that's still simmering.
Exactly. And while a direct full-scale clash is seen as, maybe less likely but still possible, any significant escalation could severely damage economies in that region.
And push up oil prices.
Potentially, yes. Maybe above $100 a barrel, which would have negative ripple effects across the whole global economy. Could even reignite some inflationary pressures we thought were fading.
Okay, that gives us the global overview and the big risks. Let's maybe zoom in now on some key economies. Starting with advanced economies, the IMF specifically forecasts slower growth for this group in 2025, right?
That's correct, yeah. The IMF's latest forecast for advanced economies as a whole in 2025 is just 1.4%, and that's also a downward revision from their previous projections.
Okay, 1.4%. Let's talk about the U.S. then. What do the sources tell us about the outlook there, especially, the labor market? It's been so strong for so long.
Yeah, it has. The forecasts for U.S. growth in 2025, they vary a little bit. The World Bank's at 2.3%. IMF at 1.8%. But the reports do highlight signs that the labor market, while still pretty tight, might be cooling off a bit.
Cooling. How so?
Well, we see data points like a decrease in manufacturing jobs back in October, influenced partly by things like the Boeing strike, one source mentioned. Job openings were at their lowest since early 2021, back in September.
Okay.
And the voluntary quit rate in the private sector, people leaving jobs willingly, that's been falling, which often suggests workers are maybe a bit less confident about finding new jobs easily.
So less job hopping.
Exactly. And average weekly hours are down too. It suggests some of that extreme tightness we saw post-pandemic is easing.
But still tight overall.
Relatively, yes. But it is worth noting, as the sources point out, that overall labor force participation still hasn't fully recovered to its pre-COVID levels. That's still a longer-term factor hanging around.
Got it. And what about inflation in the U.S.?
Right.
The CPI data seems to be trending down from those really high peaks.
It is, yeah. The sources show the U.S. CPI year-over-year rate was down to 2.3% in both April and May 2025. That's quite a drop from 3.0% back in January.
That's encouraging.
It is. Though, interestingly, some analysis in the reports links the rise in U.S. bond yields we've seen to concerns about things like the country's fiscal health, but also potentially to expectations that future tariffs could actually lead to higher inflation down the road.
Ah, the tariff effect again.
Right. And the sources also touch on the possibility of the 2017 U.S. tax cuts being extended. They suggest that could give U.S. growth a boost maybe in 2026, but probably wouldn't have a huge global impact.
Okay. Turning to Europe now. Central banks there have been pretty active with monetary policy, haven't they?
Yes, very much so. The sources show that policy rates at the European Central Bank, the ECB, and the Bank of England, the BoE, they remain relatively high compared to, historical levels. It reflects their ongoing fight against inflation.
Right.
Now, there was one point of slight variation across the sources on the specific rate for mid-2025. Some data, I think from investing.com, showed slightly lower expected rates for June 2025 ECB, maybe 2.4%, a BoE 4.25%, compared to what a Keep graph showed for actual rates in late 2024, which were higher.
So forecasts changing, maybe?
Could be forecast changing, or maybe they're referencing slightly different specific rates or dates. It just highlights how, fluid these economic projections can be. Things move fast.
Sure. And what about the labor markets in Europe? Are they seeing similar cooling signs?
It's a bit varied across the Eurozone and the UK, but a common theme mentioned is that in some Eurozone countries, labor force participation rates are still below where they were before the pandemic hit.
Okay. Germany, specifically, was highlighted as a point of concern in some reports.
It really was. One source projected Germany as the only major economy facing a potential contraction in 2024. And the forecast for 2025 is very weak. The IMF put it at a worrying 0.0%.
Zero growth. Wow. Why?
Well, it seems to be a mix of things. There are the immediate factors like high interest rates and falling exports, particularly exports to China. But the sources also point to deeper structural issues.
Like what?
Like Germany's economy being heavily reliant on manufacturing, facing challenges with low productivity growth, significant bureaucracy, a rapidly aging population, and apparently relatively slower progress in digitalization compared to some of its EU neighbors. So it's both cyclical and long-term headwinds hitting at once.
That sounds tough. How about France and Italy? Are they in a similar boat?
Both are also expected to see relatively low growth in 2024 and 2025.
Right.
France got a bit of a temporary lift from hosting the Olympics in Q3 2024 that boosted activity.
Right.
However, the sources suggest that government efforts to tighten the budget will likely temper growth in 2025, even if household spending picks up a bit.
And
Italy's growth is expected to be limited in 2024, mainly by a slow recovery in consumer spending. There is hope for a slight improvement in 2025, maybe helped by domestic demand and continued inflows of those EU recovery funds.
Okay, let's move over to Asia. Japan saw some really historic shifts in monetary policy recently. Huge news.
Huge news indeed. And the sources capture this pivotal moment. The Bank of Japan made some really significant moves back in March 2024. They ended their yield curve control policy. That's where they cap long-term bond yields. And they also finally ended their negative interest rate policy.
Big changes.
Massive. They shifted their main target rate to the overnight call rate, which is, what banks charge each other for overnight loans, hiking it just slightly to between 0.0% and 0.1%. And they also stopped buying things like ETFs and J-rights as part of their stimulus.
And there were more adjustments after that initial shift.
Yes. In July 2024, they took another step. They hiked that overnight call rate target again up to 0.25% and signaled they'd be reducing their purchases of long-term government bonds.
So a gradual tightening.
Seems that way. And the new cabinet under Prime Minister Ishiba, which took office in October 2024, seems to be largely continuing this policy direction. A key priority for them, as the sources highlight, is finally escaping deflation, that long period of falling prices, and achieving real wage growth that actually outpaces inflation. That's been the holy grail for Japan for ages.
Yeah, a long struggle.
Yeah.
Okay, let's shift gears now and look at emerging and developing economies. Are they generally expected to grow faster than the advanced ones we've just discussed?
Generally, yes. The IMF forecasts about 3.7% growth for this whole diverse group in 2025. That's definitely higher than the 1.4% projected for advanced economies.
There's always a but, isn't there?
Well, yes. It's important to remember this 3.7% is also a downward revision for the EMDE group compared to earlier forecasts. And the World Bank sources added a cautionary note that despite this higher growth rate, the actual progress these countries are making in catching up to the income levels of advanced economies has been disappointingly slow.
Right. The convergence isn't happening as fast as hoped.
Exactly.
And of course, China is such a massive part of that emerging market picture. What's the outlook there?
It certainly is. The IMF and World Bank forecasts for China's growth in 2025 are hovering around 4.0%, which again is a downward revision from previous expectations.
Still decent growth, but slowing.
Right. And the sources mention various stimulus measures that Chinese authorities are rolling out to try and support growth. Things like a big 500 billion yuan swap program to encourage financial institutions to buy more stocks, and another 300 billion yuan relending program specifically aimed at supporting share buybacks by listed companies.
So trying to boost confidence in market activity.
It looks like it. Trying to put a floor under growth, basically.
Okay. How about India? It often stands out with relatively strong growth numbers compared to others.
It does. India's growth forecast remains quite strong, relatively speaking, though it also saw a slight downward revision. The IMF is forecasting 6.2% for 2025.
Still impressive.
Yes. But the report suggests that expected interest rate cuts there might get delayed, perhaps until early 2025. Apparently, this is partly due to inflation running a bit hotter than forecast back in September, and also continued strength in rural consumption, which suggests demand is holding up and might still pose some inflationary risk.
Okay, so holding off on cuts for now, looking at some other specific countries mentioned, Russia stands out with a very high reported interest rate.
It really does, strikingly high. The sources show the Russian central bank has been tightening monetary policy very aggressively. They had 3 rate hikes in 2024, bringing their key rate up to a remarkable 21% by October.
21%.
Yeah. And despite, all the international pressures, the reports note that Russia's current account, which tracks money flows from trade and services, actually shifted to a surplus in the first half of 2024.
The surplus.
Interestingly, it wasn't driven by trade. The trade deficit actually widened. Instead, it was due to a big increase in what's called the transfer income surplus. That's essentially money flowing into the country without a direct exchange, like remittances or maybe other specific financial inflows.
Interesting dynamic. What about Latin America and the Middle East? They were briefly highlighted too.
Yeah, in Latin America, Brazil is seeing some short-term boost to demand from things like minimum wage hikes and social support programs, but it faces ongoing challenges with long-term inflationary pressures and delays in implementing big policy reforms, like their dual VAT reform, which is planned but won't fully phase in for years.
Okay.
Peru, on the other hand, is actively trying to attract foreign investment. The reports mention efforts like expanding special economic zones and offering these quite significant 10-year legal and tax stability agreements for large investments. They're really pushing the new Shinsei port as a key development to make Peru a major trade hub.
Trying to position themselves.
Exactly. Then, in the Middle East, sources indicate that the Gulf Cooperation Council, the GCC economies, especially Saudi Arabia and the UAE, are seeing pretty healthy growth. Importantly, it's driven by their non-oil sectors as they continue to diversify away from just oil revenue.
Good diversification progress.
Seems so. The UAE recorded a fiscal surplus, and Saudi Arabia's budget deficit is shrinking. The reports also point to a booming real estate market in major Gulf cities, apparently fueled by foreign direct investment, strong service sector growth, and a big influx of foreign companies and workers.
A property boom.
Yeah, and it's even showing up in financial data with a significant increase mentioned in real estate-related corporate loans.
Okay. And how about Israel's economy, given the regional context?
The sources note that Israel is facing some fiscal pressure. mainly due to increased government spending, particularly on defense, obviously. While the U.S. approved a substantial aid package, $14.5 billion, the actual flow of those funds has seen some delays, although $3.5 billion in unearmarked funds was received in October 2024. On the monetary policy front, the Bank of Israel cut its key interest rate down to 4.5% back in January 2024. And that move coincided with a noticeable drop in the U.S. dollar versus the Israeli shekel exchange rate around that time.
Right. And finally, Africa was mentioned briefly, just regarding trade trends.
Yes, just one point was made there, indicating that Africa's overall trade volume has shown some stagnation. Specifically, exports haven't recovered particularly well since the COVID-19 pandemic, which presents an ongoing challenge for many economies across the continent.
Okay, that's a real whirlwind tour of specific regions and countries. So given this really complex global picture, all these distinct challenges, different opportunities, what kind of policy approaches are being recommended by the big institutions like the IMF?
Well, the IMF reports emphasize several key areas for policymakers globally. They strongly urged countries to avoid what they called indiscriminate industrial subsidies, basically, just throwing money at industries without clear strategic goals. And they stress the importance of working together to prevent further trade fragmentation, promoting regional and multilateral trade agreements instead of just putting up barriers.
Makes sense.
They also highlighted the need for cautious monetary policy, carefully balancing the need to maintain financial stability with managing inflation expectations, plus, of course, maintaining sound government finances, good fiscal management.
And for countries dealing with volatile money flows?
For those facing volatile capital flows, they recommended tailored interventions and what they call prudential measures. So using tools appropriate for that specific country's financial market maturity to manage sudden inflows or outflows of capital, not a one-size-fits-all approach.
Okay. And looking further out, beyond just immediate stability, what were their recommendations for boosting growth in the longer term?
For lifting that medium-term growth potential, the IMF really called for structural reforms. Things like efforts to increase labor force participation, especially getting more women and older workers into the workforce. Also, expanding investment in key technologies like AI and digital infrastructure, and improving the regulatory environment to make it easier for businesses to operate and innovate.
So the usual suspects for long-term growth, but still critical.
Absolutely, foundational stuff.
Let's circle back then to South Korea, as it featured quite prominently in some of the sources we looked at. The IMF forecast for South Korea also saw a pretty significant revision, didn't it?
It did, yes. The IMF's April forecast for South Korea's growth in 2025 was only 1.0%.
Just 1%.
Yeah, and what's really significant about that number is that it represents a substantial 1.0 percentage point decrease from their earlier January projection. So that suggests a notably weaker expected growth path than they previously thought.
Oof. But there was also some quite positive news related to South Korea's financial markets, something that could provide a bit of a buffer.
Yes, absolutely. The inclusion of South Korea in the WGBI, that's the World Government Bond Index, is highlighted as a major positive factor, a really big deal.
WGBI inclusion. What does that actually mean in practice?
Well, this inclusion is expected to bring a significant inflow of foreign funds into Korean government bonds. The estimate mentioned is around $560 billion, based on Korea's expected weight of about 2.22% in the index.
$560 billion. That's huge. What kind of impact is that expected to have on the Korean economy?
Well, this massive potential inflow of foreign money into the bond market is predicted to help stabilize supply and demand for government bonds. And it's expected to put downward pressure on interest rates, potentially lowering them by anywhere from 25 to 70 basis points.
So lower borrowing costs for the government.
Exactly. Remember, 25 basis points is best 0.25 percentage points. It also broadens the base of investors buying Korean government bonds, which is seen as particularly beneficial given potential future government deficits linked to Korea's aging population and slowing productivity growth.
Right, cushions the future borrowing need.
Precisely. And these WGBI tracking funds, they're often seen as having low volatility and high predictability, which can really help the government's medium to long-term fiscal management, stable funding.
And how might it affect the Korean won, the currency, and the foreign exchange market?
There's an expected positive effect on the foreign exchange market's supply and demand dynamics simply because these foreign investors are bringing in foreign currency, like dollars, to buy won-denominated bonds.
So more demand for won.
Well, yes, but there's a nuance. The reports note that foreign bond investors often use currency hedging. they take steps to protect themselves against unfavorable changes in the exchange rate. So because of this hedging activity, the main benefit is seen more in just improving the overall supply-demand balance in the FX market, rather than leading to a direct, large increase in demand specifically to buy and hold one. It helps liquidity and stability more than driving the currency up directly, perhaps.
Got it. That makes sense. Finally, one source briefly mentioned something specific about U.S.-Korea tariff discussions. What was that?
It did, yeah. It just noted that in recent working-level consultations about U.S.-Korea tariffs, the U.S. side specifically requested the relaxation of what are called non-tariff barriers.
Non-tariff barriers, so not the actual tax rate.
Exactly. These aren't the taxes on imports like standard tariffs. They're other kinds of regulations, standards, or procedures that can make it difficult or costly for foreign goods or services to enter a market. Things like complex customs procedures, specific product standards, that sort of thing.
So the focus is also on those less visible barriers to trade.
Seems so. While tariff levels are always discussed, these other barriers are clearly on the agenda too.
Okay, so pulling all of this together then.
Yeah.
As we look ahead to 2025, what we're seeing is a global economy facing, well, revised down growth forecasts, the persistent threat of trade tensions, and these really distinct regional challenges, from signs of a cooling labor market in the U.S. maybe, to deep structural issues weighing on Germany, and specific stimulus efforts underway in places like China.
That's a good summary. And we also see countries navigating these choppy waters with very targeted policy responses and leveraging financial market developments, like South Korea using its WGBI inclusion to support bond market stability, even while facing the need for significant domestic structural reforms.
This deep dive really gives you, our listener, a kind of mosaic of the global economic landscape, drawing directly from these key sources. It paints a picture of a world economy that's still, well, adapting, still finding its footing, facing both significant external risks and the constant need for domestic policy adjustments.
Absolutely. We've covered quite a range, haven't we? From the potential for trade wars and ongoing geopolitical risk to specific country growth drivers, central bank maneuvers, and the policy tools governments are reaching for.
So what does all of this mean for you? I think it really highlights just how interconnected economies are globally and why keeping an eye on all these moving pieces, trade, policy, regional specifics is so important. It also leaves us with a really compelling question to consider, doesn't it?
It does.
In this environment, with all these competing risks and very different domestic priorities, how successfully will policymakers around the world manage to balance that immediate need for economic stability with the crucial longer-term goals of achieving sustainable, truly inclusive growth? That's certainly something worth mulling over.